The signs are glaring, but they don't want you to know what's coming. As the new year begins, it's more important now than ever before to know what's going on. The signs are not just ominous, they are downright terrifying. There's an unsettling truth lurking beneath the surface, so listen carefully as we unveil each one. 1. Significant workforce reductions and supply chain challenges have become prominent on the global stage. The supply chain visibility platform FourKites recently confirmed a substantial cut in its workforce, affecting offices in the United States and Europe, resulting in a 15% reduction. In response to these changes and a recent restructuring of leadership, FourKites aims to expedite its path to profitability, reducing its burn rate to zero and minimizing reliance on capital markets, according to a spokesperson for the company. In a parallel development, Maersk, a major player in global trade, declared intentions to cut more than 10,000 jobs and anticipated lower profits than previously forecasted. This announcement led to an 18% decline in the company's Denmark-listed shares, reaching their lowest level since October 2020. Maersk's CEO, Vincent Clerc, attributed the workforce reduction to the evolving dynamics in their industry, marked by subdued demand, prices returning to historical norms, and inflationary pressures on operational costs. Overcapacity in various regions further contributed to the downward pressure on prices. The initial surge in demand and substantial supply chain challenges experienced during the COVID-19 pandemic led to a significant increase in freight rates. However, this trend has now subsided against the backdrop of a less optimistic macroeconomic outlook. In response to these challenges, Maersk is implementing measures to accelerate cost and cash containment. The proposed job cuts, aiming to reduce the headcount from 110,000 in early 2023 to below 100,000, are projected to yield savings of $600 million in 2024 compared to the previous year. While these figures capture the financial aspects of the situation, it is crucial to acknowledge the human impact. The individuals facing job losses are not mere statistics. They are real people with genuine needs and often families to support. It is emphasized that there has seldom been a more challenging time to lose a source of livelihood than the present moment. This narrative underscores the human dimension of the ongoing workforce reductions and the profound implications for those affected. 2. Due to inflation, American consumers find themselves shouldering a burden unprecedented in decades, even as the pace of price increases has moderated. Presently, it takes $119.27 to purchase the same goods and services that a family could afford with $100 before the onset of the pandemic. To maintain the same standard of living as in January 2021, just before inflation surged to 40-year highs, the typical American household is compelled to allocate an additional $11,434 annually. These statistics underscore the persistent financial strain on many families, notwithstanding the gradual deceleration of inflation. While analysts argue that the economy remains robust by various metrics, with the jobless rate at a two-decade low, a substantial number of Americans express a lack of tangible improvements. More individuals report financial struggles this fall compared to the period preceding the pandemic. According to CNN, Moody's Analytics reveals that the average American household spent $709 more in July 2023 than they did 2 years prior to purchase the same goods and services. This figure highlights the cumulative impact of high inflation on consumer finances, even as the rate of price growth has notably slowed in recent months. Mark Zandi, chief economist at Moody's Analytics, emphasized the economic damage wrought by persistent high inflation over the past 2+ years. He noted that increased spending is primarily driven by soaring housing costs, and families are also allocating more funds to groceries, vehicle-related expenses such as purchasing, maintaining and insuring, and recreational services like cable. While paychecks have indeed increased over the past 2 years, they have not kept pace with the rising cost of living. 3. After the pandemic-related payment pause concluded last fall, the Department of Education reported that nearly 9 million borrowers missed their initial student loan payment. This equates to approximately 40% of the 22 million borrowers with due bills in October, failing to make payments by mid-November. The simultaneous reintroduction of numerous borrowers into repayment was anticipated to pose a considerable challenge. This revelation provides the first glimpse into the potential financial struggles individuals may encounter in affording their student loan obligations following the 3-plus-year freeze. To provide context, the Department of Education informed CNN that less than 26% of borrowers missed payments in October 2019, prior to the implementation of the pause. According to the Federal Reserve Bank of New York, millions of Americans collectively owe $1.6 trillion in student loans, with borrowers under the age of 40 accounting for 55% of this total debt. Last year, the Consumer Financial Protection Bureau identified 5 risk factors contributing to potential student loan delinquency, and one of these factors is the rate of delinquency on non-student debt since the pandemic's onset. As of March this year, around 2.5 million student loan borrowers had at least one delinquent non-student loan, an increase of about 200,000 borrowers since September 2022, according to a June CFPB report. For those preparing to resume student loan repayment, the median monthly payments on non-student debt obligations have surged by 24%. Younger borrowers, in particular, have been significantly impacted, experiencing an increase of up to 252% in their median monthly payments, rising from $65 to $229. The average federal student loan borrower currently has an outstanding balance of $37,338, while the average private debt stands at $54,921 per borrower. In the interim, many borrowers are grappling with greater challenges in repaying these loans than before the temporary repayment pause initiated by the Department of Education in 2020 during the early stages of the COVID-19 pandemic. Amid a high cost of living and escalating interest rates, borrowers have accumulated other forms of increasingly burdensome debt, including mortgages, auto loans, and personal loans. 4. The Federal Reserve finds itself in a challenging position, grappling with potential policy challenges amid growing investor concerns about the staggering $33.5 trillion in U.S. government debt. Worries regarding America's fiscal future have led to an unexpected surge in U.S. bond yields, prompting policymakers to consider delaying plans for another interest rate hike. The unease on Wall Street over the U.S. budgetary situation poses risks to both aspects of the central bank's dual mandate. Concerns about deficits and debt exert upward pressure on long-term interest rates, posing threats to economic growth and employment. Simultaneously, it can fuel inflation, particularly if the Fed appears to downplay its commitment to price stability in order to manage the government's borrowing costs. It is widely acknowledged that the United States faces a significant spending problem, and the Federal Reserve has limited options to address the substantial debt burden on the government and its citizens. Despite optimistic assertions to the contrary, a looming recession is evident, although some prominent figures dismiss this possibility. There is a prevailing belief that the Fed has successfully conquered inflation and steered clear of pushing the economy into a recession. However, this optimistic perspective is arguably wishful thinking. The inevitability of a hard landing persists, and if the central bank refrains from preemptively lowering rates, the landing could be even more severe. The notion that the Federal Reserve can raise rates from 0% to over 5% without triggering a recession is met with skepticism. Historical evidence demonstrates the challenges the Fed faces in normalizing rates, as witnessed in the attempt to increase rates from around 1% to just over 5% in 2007, resulting in the most significant recession since the Great Depression. The early 2000s saw artificially low rates contributing to mistakes in the real estate market, leading to a collapse when that period concluded. As the Fed sought to normalize rates, markets attempted to rectify imbalances built up over years of artificially low rates. In addition to quantitative easing, including significant rounds before and after COVID, the central bank is currently shrinking its balance sheet and withdrawing liquidity from the financial system, an approach not taken in the lead-up to the 2008 financial crisis. The current situation represents a more substantial shock to the system than the Fed's actions in 2008. 5. Delinquency rates for almost all types of loans have been increasing from the exceptionally low levels observed during the pandemic, as per data from the New York Fed. The uptick in delinquencies is particularly notable among credit card borrowers, serving as a clear indication that consumers are facing financial constraints despite the appearance of a robust economy. In the third quarter of this year, credit card delinquencies saw a 21 basis points increase, reaching almost 3%, marking the highest level since the first quarter of 2012 when assessing past due debt held by commercial banks. This surge in delinquencies coincides with the outstanding credit card debt hitting a record of approximately $1.2 trillion this year, accompanied by a record interest rate of around 23%. During the third quarter, the percentage of auto borrowers at least 90 days behind on their loans reached 2.53%, as per Federal Reserve data. This level is the highest observed in over 13 years. Without a doubt, these are terrifying signals, and the truth is that it's about to get even much worse. Even more shocking than all these is the response of billionaires to economic uncertainty, which adds another layer to this complex narrative. While public messages convey optimism, the actions of the ultra-wealthy, investing in elaborate underground bunkers and security measures, suggest a different story. Their preparations for scenarios reminiscent of dystopian movies raise questions about the stability of our world that may not be apparent to the average person. In addition, media influence and public perception play a significant role in shaping our understanding of the world around us. The prevalence of themes like division, economic collapse, and societal upheaval in recent entertainment releases may be more than mere coincidence. The times ahead are uncertain, and it is paramount that we remain vigilant, proactive, and well-informed. The issues we face are not abstract. They impact real people, real lives, and the health of our nation's economy. As we navigate these turbulent times, let us thoroughly question the narratives presented to us, stay connected to our communities, and work collaboratively to find solutions to the economic challenges that lie ahead. Thanks for watching.